There's still people coming in through the room, and we will let them all in. But in the interest of time, we do want to be very prompt. We don't have a ton of information. We'll go through a few things that are pretty specific, and then obviously invite you to ask any questions here or offline once we're done. Thank you for joining us today. If we've not talked before, I'm Joel Olson, Mortgage Experts, mortgage broker. We cover markets really all around British Columbia. And so, one of our main specialties is we do finance a lot of properties that are difficult. So if we think about in terms of, what is something that that we see a lot of is that when people ask for a pre-approval, we remind them very vigorously that the property is part of the pre-approval. And so, 25% of deals probably get turned down because of a property issue. And, there's property issues that are seen. Everybody knows something quirky about a property, or unseen things that make a big deal from that perspective. So we're going to go through some options today. Certainly not an exhaustive list. There are still things that come up all the time that may or may not be things that can cause financing issues. So we're going to attack a few of them here. So first of all, let's talk about land. This is a big thing that will come up if you're financing bare land. And to be clear, what I'm talking about here is where there is no structures on the land. Now, is this financeable? Now, a few things to be aware of here. Banks pretend they do this, but banks rarely lend on this. And so we encounter on a really common basis people that go into banks and being told, oh, they'll be able to do something or this much down, and normally get declined. So remember, banks rarely do this. We often do this with credit unions. They do have a land loan program around with it. But to be honest, a high amount of people we finance with land we do privately. And so land can be financed privately. There's no income, no credit required. That is a big reason why people get turned down. It's hard to, if you buy a property and then you have the rental property, now you're servicing the rental property, but a piece of land, it's truly just an extra debt added to your debt ratio. And that can be a problem for clients going forward. So we do finance it privately where there's not a credit requirement or income requirement. 25% down if it's service land. So that means it has hydro, sewer, and power. 50% if there's nothing on there whatsoever. It's highly recommended with clients. Consider the financing is certainly cheaper if they have a build project at the same time, but it's not usually possible. But if they can do that, that's going to make a significant difference on their financing as far as if they have plans to build at the same time. Doesn't mean they have to build the day after, but actually have a plan and process into play. So that's important as well. When it comes to land, we often finance that privately, no income, no credit, just because that's how people service. So a lot of people, like I said, are told that they could get it financed and find they're shut down by the bank from that perspective. Let's talk a little bit about native and leased land. So this comes up from time to time for us. Native land, the most common type of leased land, but of course there is government leased land as well. And so this means that the land itself, in the case of native land, it's still owned by the native band, and the native band has a lease that lasts a certain amount of time, usually even 100 years in length. I'm sure many of you have seen it, where they can lease the land and buy them there. Now, a lot of lenders do not do native land, and we hear lawyers say, well, what's really the difference? It's just the reality is they're just not set up logistically to do it. So it's nothing to do with even the risk. They're just logistically not set up to lend on native land from that perspective. Now, big thing here is that every single lease, every single band has different leases and arrangements. And so, like if it matters if it's on the list. And so CMHC and Genworth, they have their lawyers review the list. And if they approve those, generally that's the list people go off as far as lenders. Now, to get on, what happens if you encounter a native lease land and a broker or lender tells you it's not on the list? How long does it take for someone to get on there? Well, actually, years. Years. So it's definitely not a quick process at all. So that is so that's very important to know that if it's on the list, it's not quickly going to go on the list, and you're not going to make a two-week subject approval change anything on that. So best thing to do when you come to lease land, and again, this does cover government lease land too. People do have government lease land. Parks Canada is a big thing we see. General rule of thumb is a big thing is length of lease. If the lease is only for 20 or 25 years, they're going to lend a lot shorter. be very aware that lenders do have a different guideline based on lease. They might say, oh no, we'll do this one based on 10% down. We do this one based on someone have a certain level of debt ratios or net worth. Those are all things that exist and change from lender to lender. So very different policy. So if you're ever having a client interested in native land, it's so important that they get the rundown beforehand on what's involved with it. It is as long though as it's on the CMHC and Genworth list, which doesn't take us long to find out, there's always a financing option. If it's not on that list, it's generally going to be completely unfinanceable. You can submit it to be on there, but there's usually a reason it's not on there. Other examples of things we're financing right now. So this is a great thing we saw really lately is cob houses. So cob houses are houses that are built into the side of a hill or something like that. And this raises a question, not so much cob house, but we get people a structure that looks unique, whether it's a cob house or a yurt or something like that. So it's important to know that as a blanket rule, CMHC does have a policy that those are all allowed to be financed, but it's so important that you're really looking at two things. Anyway, a lender wants to know, is it marketable? Could they sell it if somebody forecloses? And so, if it's normal for the area, that's going to be a big deal. One thing that comes up quite often for us is probably two things that people struggle with. A is that if a home is a residential home but has commercial zoning, there's a lot of lenders that do that, but we have to verify that it makes sense for the area. So it's still case by case situation. You'll get things that are even smaller yurts or unique structures. These are all financeable as long as we've cleared them before and painted the picture and painted the story of how that can be resold. Low square footage. And so this is something that comes up from time to time. General rule of thumb, 750 square feet for a house, 500 square feet for a condo. Anything lower than that can be an exception. Now, if you have a house that's 500 square feet and the garage is 250 square feet, that counts as 750 square feet. Now, here's something interesting people don't realize is that, like, if you get below those, let's say you come to us with a condo of 325 square feet or something like that, that can be financed. But you're not going to have a lot of luck putting 25% down, but you have a lot of luck putting 5% down. As far as something else we did recently, houses that have no septic, so just an outhouse or house, that was actually a pretty easy approval for CMHC. So if you see unconventional septic and water sources, those are all things going to be financed. Usually what happens in those situations is that people go to a broker or a bank and they don't even do the due diligence to go further on. That's where the problem comes in. Hoarder houses. So this was something we ran into lately. If a house looks really good, it's in not very good, in disrepair, packed full of stuff, that's not going to be a house that can be easily financed. Kiss of death is when someone says to us, oh, land value is just there. Lenders are horrified by the idea that something only has land value to it being enough. They don't want anything. They would rather have a blank canvas piece of land than a house that's decrepit and brutal from that perspective. Now, we typically finance all those privately, so those can all be done. Those hoarder houses, those homes that look bad. We saw one that had a piece of plywood on top of the garage, no garage door. All that stuff can be done, but clients have to understand that's going to be private finances. They might be paying 7 or 9% for a certain amount of time, and they have to offer and price that accordingly when they go ahead and do that. The last thing we want to cover is obviously mobile homes. So mobile homes on pads, no matter what anybody tells you, anything older than 2000 is completely unfinanceable. CMHC doesn't do them. Now you might say, oh, but I've seen a couple of them get through. They go through accidentally. It is a luck of the draw. It gets approved accidentally. There is some wiggle room if the place has been fixed up. Technically, though, anything older than 2000 can't be financed. That same rule applies when mobiles are on land. When mobiles are on land, it technically can't be financed if it's older than 2000. But they do make exceptions if there is good land value and if there's been good updates to everything. But painting the picture, like us knowing about plumbing, foundation, electrical, and any updates is very important to getting approved. And it's certainly not a blanket rule or non-blanket rule. The other thing to remember with mobile homes is that some lenders don't like if it's a mobile home setting. So you often get bare land stratas that look like mobile home parts. Some lenders don't like that, even though you do own the land. So that's mobile homes. Then the last thing I wanted to cover before I open up for questions. Good one here too. Tiny homes on land. So tiny homes, totally financeable. Two ways to be done. First of all, Some people are doing them as shadow loans. So shadow loans would be like if it's a mobile in a park, but that's a difficult loan to get approved for. What needs to happen with a tiny home is a tiny home needs to actually be secured to the ground, anchored down, foundation on. Now that is not always possible, but if it wasn't, then it would be considered like a mobile home or a shadow loan, which is possible to do. There's a way to do it, but that is not as easy and much more expensive. So if that tiny home goes on land, it's got to be anchored down so it can't be moved, and it becomes part of the property. Last thing I want to cover here as well would be, I had a question earlier about it, and it's a great thing, fractional ownership. So what happens if you get, this happens a lot in ski hill properties. Somebody buys a home, you're getting an eighth of the property, access to it by 3-4 weeks a year. You're buying a property that there's several owners on that. Now that is almost impossible to have financed by by a conventional bank. Now, however, what happens with those? We often always do those privately. So 7 to 9%, we have lenders that do it. So one thing I have to think about with a fractional ownership or something like that is that it's about cash flow. And the same thing could apply when someone's buying a ski hill property as a rental pool, which is issues for lenders, is that someone has to go, if an interest only payment on 7 to 9% is going to be the same as a 2 to 4% amortizing loan. So someone's buying a property, and I use the example of a ski hill property. If they are doing that, it's going to cost them, and they're spending $200,000. It's going to still cost them $1,000 a month and be pretty similar regardless of payment. So this is a really key thing, that if long clients get the payments are not that much more expensive, even though the interest rate is, from that perspective. So the risk, of course, is that the rate is higher because the lender has a difficult situation trying to do so. Private, what are fees involved with private lenders on builder loans? So generally, they vary, but a good rule of thumb I use is usually 2% on the balance. And so, so for example, we had someone do it this week, they're going to pay $15,000 in fees. So what I recommend to them is to look at two scenarios. Is the price you're paying for, if you bump that price up by $12,000, would that be what you'd still pay for? And they say, well, no, of course we would. That's a no-brainer. It's still that good of a deal. Okay, great. So we know they're not really paying extra. If and this would be more applicable in a market that's not as busy, but when a market, if not, what you would do is the client might go back, say, what, we need to get $15,000 off the loan to make it worth our while. So that's what I always say to people: go back, take your costs off as part of negotiating on top of that. A builder's loan only lasts for a year, or a private loan for a year. So the idea is they do it for a year and then we get them into something better at that time. All right. Any other questions before we sign off today? Again, this has all been updated, where it's going to be on things. Yeah, it's all been updated so that it'll be on our YouTube site. If you have any particular deals you want to reach out to us on, please do. Please do reply to the email. We'd love to help your clients. And then we definitely love these types of deals. Yeah, so that would be great. So thank you so much for coming. And again, happy to help you with any of your real estate needs. And I bid you a great day. Thank you so much.